In the second quarter of 2026, economic headlines in North America were dominated by a shifting interest rate narrative, as central banks moved away from an expected easing cycle toward a more cautious, higher for longer stance. Both the Federal Reserve and the Bank of Canada held policy rates steady at 3.75 in the US and 2.25 in Canada, signaling that inflation remained above target and that further progress was needed. Now, at the same time, updated forward guidance and economic projections pointed to a slightly higher path for interest rates through year-end, reflecting concern that inflation would prove more persistent than previously expected. In fact, the next interest rate moves are trending in the direction of hikes, not cuts. The futures market is expecting one hike from the Federal Reserve by year-end and one hike from the Bank of Canada, but not until 2027. Notably, Kevin Warsh has now transitioned into chair of the U.S. Federal Reserve and chaired his first Fed meeting in June, followed by his first press conference. His comments were more hawkish than the market was anticipating. Hawkish meaning he favors rates moving higher, not lower. Central bank caution was driven in large part by inflation dynamics. While core inflation showed signs of stabilizing, headline inflation is rising, driven by rising global energy prices and rising energy costs directly linked to the supply disruption caused by the Strait of Hormuz remaining closed. Now, since the beginning of the conflict, North American gas prices have risen to 38%, and therein lies the inflation story. Central banks acknowledge that these energy-driven pressures could delay their return to the 2% inflation targets and risk becoming more entrenched. The silver lining to this story is that the U.S.-Iran negotiations are, allegedly, making progress and ship traffic will begin flowing through the strait. We've read these headlines before. Nonetheless, energy prices have moved significantly lower, with WTI and Brent crude now trading closer to $70 a barrel. This is 35% below their recent highs. Now, in due time, inflation will also come down. Meanwhile, economic data releases painted a mixed picture. Growth remained positive but modest, with forecasts for both the U.S. and Canada revised slightly lower, suggesting a slower expansion than anticipated earlier in the year. Labor markets continued to show resilience, with unemployment remaining relatively stable. Against this backdrop, the Diversified Income Fund delivered a return of 2.1% for the quarter. April, May, and June were constructive, with returns of 0.2%, 1.4%, and 0.6% respectively. This leaves year-to-date performance at 2.6% overall. Now, amid the market volatility, it's important to take a step back and consider the role that Matco's diversified income strategy is designed to play. The fund generates a 4.4% yield, offering a meaningful premium relative to money market and GIC rates. For investors seeking stable income with a focus on capital preservation, that income stream remains a key component of long-term returns. Now, throughout the quarter, we were active in positioning the portfolio to reflect the fund's strategy within this current environment. First and foremost, we reduced the interest rate sensitivity of the fund. For the more sophisticated, this means we reduced the fund's duration, with a current position of 6.45 years. This duration is 0.6% shorter than the Canadian bond index, for context. This reflects our view that although short and medium-term rates have likely reached a point of equilibrium, the risk-reward of investing in longer-term interest rates simply isn't as compelling. The thesis behind our view is that inflation will linger above the central bank's desired 2% target. In addition, bond investors aren't loving the elevated and ever-increasing government debt levels. By contrast, we think the 5- and 10-year part of the interest rate curve does offer great value, particularly in selective corporate bond positions. This segues us nicely into our next portfolio adjustment. During the quarter, we added 2 new corporate bond lines to the portfolio. Namely, we added a Fairfax Financial 10-year bond at a 4.4% yield and a TC Energy 10-year bond at 4.53%. Fairfax Financial is a Toronto-based financial holding company primarily centered on property and casualty insurance and reinsurance, alongside a value-driven investment portfolio. TC Energy, as most of us know, is a Calgary-based energy infrastructure company that builds and operates pipelines and related assets across North America. Both positions reflect attractive yields within our 4 to 5% portfolio yield target. For those who have been following along, we continue to add gradually to our Canadian dividend equity income sleeve within the portfolio as well. This past quarter, we initiated a position in Peyto Exploration. Peyto Exploration is also a Calgary-based energy company focused on the exploration, development, and production of natural gas, primarily in Alberta's Deep Basin. Now, as of June 30th, the Diversified Income Fund's investment mix is represented by a 38% allocation to corporate bonds, 24% in federal bonds, 24% in provincial bonds, 10% in mortgage and investments, and a 2% dividend-paying equity sleeve. Lastly, 2% remains in cash. Now, the broader outlook for income-oriented investments has become far more complex. We've touched on this before. Although the market is anticipating rate hikes, our assessment of fundamental data suggests easier monetary policy is actually needed. North American labor markets are seeing slower growth in jobs, while consumer activity has been resilient but cooling gradually. Housing markets would in fact be supported by lower interest rates, and GDP growth overall is trending sideways, not necessarily higher. However, given the battle against inflation and rising energy prices, central banks are less likely to cut prematurely and tempt to reinflation. In this environment, the traditional playbook of pairing stocks with bonds for diversification has become less bulletproof. Over the past several years, those asset classes have moved more in tandem, reducing the effectiveness of a purely balanced approach. As a result, income portfolios need to be constructed more deliberately. That means expanding beyond traditional bonds to incorporate a broader set of income-generating assets, including corporate credit, mortgages, and dividend-paying equities. Sound familiar? That's how our portfolio is positioned today, with a focus on preserving capital, generating reliable income, and proper diversification to navigate all the uncertainty while still compounding returns over time.